Canadian and US stocks trading in record territory again today. Let's focus on the S&P 500. That important benchmark, even if you exclude dividends, is up 28% so far this year. The Nasdaq's up almost 32%. Our guest says the party could wind down. We have to be wary. We're joined by Drew Pettit, U.S. equity strategist at Citi Research. Drew, thanks very much for coming on the show.
Well, thanks for having me, Andrew.
Just looking at the S&P 500, it's just under 6,100 right now, and your year-end target is about 6,100?
Yeah, that's been our bull case for most of the second half here. And honestly, post-Trump election, we really saw the S&P 500 run. What we think is happening is investors are paying forward for some of the America First policies that they believe he will put into place, including tax cuts for domestic manufacturing and just a broader deregulation push. So in the last few months, we're getting pretty close to that 6,100 bull case.
You are saying that investors should think about lightening up on U.S. Stock exposure?
Yeah, I think if we breach that 6,100 number, we might see a little bit of buying exhaustion. I know you're going to hear a lot of strategists talk about, the Santa Claus rally and a lot of really good seasonality into year end. But I think all of that is basically going to take away from the first half returns from next year. So again, 6,100 is the line we've drawn in the sand for a couple months now, and we're getting pretty close to it.
And are you worried about euphoria here? Because November saw a massive inward flow into U.S. equities.
Yeah, so I'll start a bit more broadly on sentiment here. Yeah, getting a little bit concerned. You're starting to see some of these more niche-y, higher risk pockets of the market starting to pop again. You're starting to see really aggressive, I'm going to say like retail volume, not a ton of hedging activity and options pricing. There's a whole bunch of signals in the background that make us think sentiment is a little bit extended. And look, just at least short term, I think the flows have been supportive and why we can kind of stick around the 6,000 level for the past little bit. Mm-hmm. But yeah, sentiment is extended.
But ETF flows into ETFs in the United States, generally steering clear of international stocks?
Yeah, so the flow picture in November was eye-popping to us. And we've been tracking U.S.-listed ETFs for almost 15 years now as a team. And it was a record. We had 30 billion more inflows than we had ever seen in a month. So that total for domestic equity buying for U.S.-listed ETFs was $120 billion last month. Massive. And the number for global or international exposures was 2. So we're looking at 120 billion to 2 on the other side. So Trump said America first, and ETF users, well, that's what they did with their dollars.
Maybe we could put up a 10-year chart for the U.S. 10-year bond yield, because really since the early 90s, their investors in equities have had this tailwind with falling interest rates. Is that era over for the next decade or so?
It may be, but this is what's really interesting. When you look at the relative valuation of the S&P 500 against Treasury yields, it's kind of back to where it was pre-GFC. So I think, there's a little bit of a recency bias when we see yields up. Yeah, they're up, but we just had quantitative easing for years and years and years in the United States. Mm-hmm. So it's up from kind of abnormal levels. And then the one thing equities have that bonds really don't is that earnings number, and that earnings number moves. So yes, while yields get more attractive, while falling rates might not be the tailwind to just rush into everything equities, we have really good earnings growth, which makes us comfortable with the cross-asset valuation. It's just the short-term sentiment setup just gives us the jitters right now.
And just if you could give me that again, were you talking about the earnings yield versus the bond yield, Drew?
Yes. Thinking about earnings yield, so just kind of flip PE on its head here.
Yeah.
So that's where when we think about that cross-asset valuation, it's back to pre-GFC levels. So again, yeah, it looks different than what we experienced post-2008, but we're getting back to a little bit more of a normal place with the 10-year in the U.S. yielding over 4%.
And yeah, that's right. It's good. Thank you for reminding us. We've been in this kind of artificial world since the 07, 08 period. And so just to clarify then, the earnings yield is fairly attractive compared to the bond yield. Was that your point?
I would say it's fairly neutral for what it's worth. I would just say, like, if you thought about this on a short-term horizon, you might go, oh, it's very unattractive. But on a longer-term time frame, yeah, it's pretty normal. It's pretty neutral.
Drew, before we let you go, is there something that you think investors are discounting too much or ignoring, possibly at their peril right now? I know it's a black swan by definition, you can't forecast, but is there any risk you think we should be mindful of?
Honestly, I think we have to be wary of tariffs and how they go through. If that ends up being a gross margin hit to U.S. businesses, it can be negative for an S&P 500 that's pricing in a lot of good news. Not pandering to the crowd here, and for what it's worth for the viewers, I'm actually a Canadian citizen as well. But free trade, fair trade probably benefits all parties. Aggressive tariffs probably end up hitting U.S. companies, actually. So that's on our radar. We still have a lot of policy uncertainty, and we have to make sure we balance the good with the bad.
Drew, thank you very much for joining us. Drew Pettit has been our guest.